Hello, everyone. So thank you for joining us today to our third session. So Anthea is going to share her screen. Anthea, before you share your screen, just 1 second.
Sure.
Let me just share this one real quick. Okay, just a quick reminder of the census because it's very important for our community. So I just want to remind everybody to do their census. If you already done it, that's great, and then you can just share with everybody else. Just let them know that. Just remind them they have to do it because it can help our community to receive funding for the next 10 years, right? It can help with hospitals, school, roads, transportation, and all of it. So please, if you already done it, thank you, and or if you have to do it, just log in 2020 census.gov. It's very simple. So you should receive the a letter who has your I think is some letters you just have to enter is your notification is your information. So you just enter it and you can just fill it out. Again, thank you. So that's it.
Okay. So, all right. So, trying to share screen here. There it
Okay.
is. Okay. All set. Oops. Okay, so welcome back to the third session of Money Made Simple. In the previous weeks, we talked about the importance of budgeting to figure out exactly where you are, how your money comes in, how it goes out. And it's the key to money awareness and exerting control over your financial life. Last week, we had two fairly complicated topics. We talked about credit, how to understand your credit report, and how your credit score is derived from the information on your credit report. And then we shared some ways that you can improve your score over time, key things that you can do. We also talked about debt, which is important to know, particularly how to get out of debt in a time and cost-efficient manner. I hope that that was valuable to you and that you're comfortable with all of that information. Today, we're going to talk about another very important topic in the world of personal finance, which is investing. Because even if you don't feel like you have enough money to invest, you may very well have a retirement savings plan at work, a 401k plan or a 403b plan, and you need to know the basics of investing to make sure that you invest that properly, because that is likely going to be most of the money you have when you decide to retire and stop working for a paycheck. Before we begin, just a couple words about PSS. Again, it's an agency founded originally in 1962. PSS Life University, which is where Money Made Simple is presently housed, offers educational and other programs currently online and at 10 local senior centers, keep seniors healthy, engaged, and connected. They provide free personalized support for those caring for anyone who is frail, chronically ill, or with dementia. They also serve grandparents raising family members. They have a coming of age program to inspire people 50 plus to live with passion and purpose, and they rely on volunteers for a lot of their value-added programming. So here's our agenda for today's session. And my hope in sharing with you investing basics and what the keys are to successful long-term investing is to help you understand the essential terminology so that even if you have a financial advisor, a broker, an investment manager, you are clear when they are speaking with you on what they're talking about, and that you understand a lot of the terminology and don't feel intimidated asking questions. I don't know if any of you logged in to hear Warren Buffett give his annual update on Berkshire Hathaway on Saturday. It was the annual shareholder meeting, was done virtually for the first time, so it was rather odd. Just Warren Buffett on a stage with some printed out slides. But he talked again about how investing is for the long term, and that in time, over time, we will get out of this current pandemic situation, and that he is a big believer in the financial success of the country. Right now is very uncertain, but over the long term, he recommends index funds, which is something we're going to talk about, low cost, very diversified investments, and is a key to long-term investing success. One of the things we'll also talk, just returning again to the agenda, we'll talk about what constitute a diversified investment. We're going to talk about historic stock market returns. And today, in the context of what's happened recently with the market crash back on March 23rd. And then I'm going to wrap up with a quick overview of various types of advisors in the world of investing advice, investment representatives, advisors, and financial planners, what the essential differences are among them. So to begin, one of the very important concepts we need to master to begin to invest with confidence and skill is an understanding of what asset classes are. You hear that terminology all the time. If you listen to CNBC, if you listen to Bloomberg, you hear asset classes, asset allocation. And what does that mean? Essentially, asset classes are particular categories of investments where you can invest your money. So the very simplest is cash. If you have cash allocated in your portfolio, that it represents liquid funds that are held either in a money market account or a bank or treasury bills, something that is very short term, very liquid. You could spend it today or tomorrow. So that's cash. Bonds are an interesting asset class. They are long-term debt that are sold to investors, and they can be issued by corporations, by government entities, including the federal government, state governments, city governments, etc. And what it is essentially is an agreement to pay you back. So you invest, say, $10,000, you get what's called a debenture, which is an agreement that you will be paid your principal back on a stated maturity date. And in return for this loan, the borrower, the issuing entity of the bond, is going to pay you a coupon, which represents interest. And typically the interest is paid every 6 months. And at the maturity of the agreement, you get your principal back. Another asset class are stocks. Stocks represent a share in the ownership of a company, meaning that they are a claim on assets and earnings of that particular organization. That's why it's referred to equity, same concept as the equity in your house. When you pay down a mortgage, you increase your equity, you increase your ownership in that particular asset. An alternative, and this term has come about and become very popular since 2008, the great financial crisis, when a lot of investment managers realized that in a crisis, and that was a financial crisis involving the collapse of the mortgage markets, some element of fraud, and an awful lot of dislocation, both stocks and bonds, which traditionally had worked to offset one another. So if stocks went up, the value of bonds typically declined, and vice versa. If stocks declined, the value of bonds would go up. So it used to be a fairly simple premise that if you wanted to protect your position, you would invest in both stocks and bonds so that regardless what happened in the markets, you would be diversified and your principal would be somewhat protected. In 2008, that didn't work so well. Everything went down at once. Both stocks and bonds collapsed in the early months of that crisis. And as a consequence, there was a great interest in finding alternatives to stock and bonds that would behave differently in a market crisis. And this was driven largely by institutional investors who are portfolio managers that manage foundations, they manage endowment funds, like for big universities, and for pension plans. And they went out, and this continues today, and invested a lot of money from these institutional portfolios in real estate investment trusts, in master limited partnerships, in oil wells, in private equity, in timberland, and even in raw, undeveloped land. The whole idea was to create an asset class that was not going to respond to anything that happened in the stock and bond markets. Other asset classes include currencies. These are traded typically using futures, and commodities. So you've heard of oil, corn, soybeans. We used to have pork bellies. I don't think they're called that anymore. These are commodities, and precious metals. So all the usual ones: silver, gold, platinum, and then there's some more obscure metals as well. Types of investments. So we've reviewed the asset classes. You can own stocks or individual stocks, and you can own individual bonds. You could also purchase stocks and bonds through mutual funds. And mutual funds are large portfolios. If they're actively managed, they're run by a portfolio manager or a team that is looking to select investments that are going to grow in value or remain stable, depending on what the fund objective is. So as a mutual fund investor, you buy shares in that overall fund. As more people join the mutual fund, more shares are sold. And depending on how the investments in that portfolio do, the value of those shares go up or down. You'll see references to NAV, net asset value. That's the value of the individual shares you hold. Actively managed mutual funds, as I mentioned, have a portfolio manager and usually a team of researchers working to find good investments to actively buy or sell in that portfolio. A passive index fund is typically not as labor intensive. The most famous passive index fund is the S&P 500. You may know that Vanguard, one of the largest investment companies on the planet, was the inventor of the index fund. So they came out with a fund back in the 70s that mimicked what the S&P 500 did. So the S&P 500 are 500 of the largest companies in the US that meet certain criteria: positive earnings for 4 quarters, certain asset size. And so this index is fairly static. So Vanguard decided that they would mimic this and sell this to retail investors. This did not take off for decades. It really didn't attract a lot of attention in the 70s or the 80s. But more recently, there has been a great shift into passive index investing. There have been academic studies suggesting that this is a better way to invest, that active portfolio managers are not consistent in beating the market. So you are better off as a long-term investor investing in the actual S&P 500 or a total market index, paying less in expenses and getting a market return. Okay. Exchange traded funds, and we've got a slide on this that goes a little bit deeper. There's another place where you can buy investments, and they're exchange traded funds that invest in equities, that invest in bonds, or that invest in alternatives. It is where all the growth in new investment products seems to be. New ETFs coming out all the time. REITs are real estate investment trusts, and these are essentially, they can be publicly traded, meaning they have their own ticker symbol and you can buy shares in it, and they invest in real estate of different kinds. Some are focused on commercial real estate, so they will invest in office buildings, in malls, and other types of corporate real estate. Others are invested in apartment buildings, and even others are invested in industrial warehouses and storage units. MLPs, that stands for Master Limited Partnerships. These are organized to invest in things like oil well drilling ventures and a lot of exploratory mining type things. It's not a category we're going to go into at any depth because it's sort of a niche type of investment for people with a lot of risk tolerance. So how do investors make money? Well, when you buy your individual stocks and bonds, or you buy mutual funds, whether these are active or passive, you are hoping that your investments go up in value. If they go up in value, you have what's called a capital gain. If they go down in value, you have what's called a capital loss. Now, there's a difference between a short-term versus a long-term capital gain or loss. And this has to do with how gains and losses are treated from an income tax standpoint. If you hold a stock or a bond for less than 1 year and you sell it and you have a gain, you have a short-term capital gain, and that is taxed like regular income. If you hold it for longer than a year, so a year and a day, and you sell it and you realize a gain, you now have a long-term gain, and that gets a preferential income tax rate. It's much, much lower than your regular wage income taxes. In addition to getting either a capital gain or loss, you're also hoping that your investment will pay dividends if it's a stock, or interest if it's a bond. So that adds to your return on your investments. Where can we hold these investments? How do we go about this? Well, the most flexible place to own any of those types of investments is in a regular brokerage account. And I refer to this as a taxable account because as you buy and sell investments in your regular brokerage account, you will realize gains. You will also presumably receive taxable interest and dividend payments. And so at the end of the year, you'll get a 1099 div and you'll pay income taxes on that income. You can also have qualified money, meaning a rollover IRA or a SEP IRA in its own brokerage account. There too, you can hold all sorts of different types of investments, whether these are mutual funds, individual stocks, individual bonds, ETFs, REITs. These all can be held in brokerage accounts, either taxable or tax deferred. You could also, if you're just interested, for example, in buying mutual funds from Vanguard, you can have what's called so we were talking about types of investment accounts, and I got to Vanguard. If you wanted to open up a direct account with Vanguard because you never intended to buy anything beyond mutual funds, you can do that online. You can call them up, they'll mail you an application, and you can have what's called a direct mutual fund account. The other place where most of us invest through our employee retirement savings plans. If you work for a publicly traded company, that would be called a 401k plan. If you work for a nonprofit or in government, you'll have access to a 403b plan. They are very, very similar. The difference in code refers to where they're described in the tax code. So literally 401k is an IRS name, and 403b is as well. They have the same contribution limits, they have the same requirements. One of the great things about investing in your company's retirement savings plan is that they are so highly regulated that there is very little chance of being defrauded or having problems. They're regulated not only by the IRS, but the Department of Labor. They're subject to all kinds of reporting requirements. And your employer is required to be a fiduciary. So they own the problem if anything goes wrong. That said, the requirement to invest that money appropriately falls with each of us, which is why it's important to understand how investing works so that you make good decisions and you select long-term investments that are appropriate to your long-term goals. Another place where many of us can invest are through what are called employee stock ownership accounts. So if you work for a publicly traded company, say Coca-Cola or IBM or Uber, any that is publicly traded, they will often offer as an employee benefit the opportunity to buy shares in the company, typically at a discount, which is their incentive and why it's a benefit. The discount can be 10 to 15%. You would generally buy this either through payroll deduction or through quarterly checks. And over time, you can amass a pretty good amount of employee stock. You don't want to be overinvested in your employer stock, simply because if something happens to that company, and think of all the great companies that have seen significant downturns, not only is your paycheck from that company, but your investment is very, very big in that particular company, and all would therefore be at risk. So it's a great idea to buy some, but don't be overinvested. You'll want to sell some and diversify over time. Now, before we get into other very important terminology, I want to focus for a minute two big terms in investing: risk and volatility. They're often perceived to be the same thing, and that is not at all the case. When investment professionals talk about risk, what they are talking about is the risk of actually losing your principal, losing your money, investing in something that, just doesn't work out or falls apart, and your money, the value of your investment goes to zero. That's risk, absolute loss. Volatility refers to the fact that every trading day, the value of your investments go up and down. People are feeling good about the markets and economic prospects for the company, or for the country rather. Stocks go up. If people are feeling less optimistic, feeling a little anxious over uncertainty, things like the pandemic, you're going to see it go down. Try as we might, this is hard to predict. So you have to understand that markets are going to go up and down. Generally, when things are just chugging along, the market volatility is fairly tame. It'll go up 50 points, it'll go down 50 points, up 100, down 100. It doesn't really get people excited. But when you have something unexpected happen, which could be like this, the outbreak of the coronavirus, when suddenly this was a national emergency, people panicked, the market sold off. We saw a lot of this in March. Great anxiety because nobody understood much about this illness and what was going to happen. Other things that can trigger a big market move: the outbreak of a regional war, other market, risk of war can sometimes send the market up or down. And then when there's really good news, and most recently we've seen that with the announcements of things like promising vaccination and promising treatments being approved by the FDA. People feel better about this, things seem less uncertain, and the market rallies. So just remember that these things are distinct, that risk is risk of loss and volatility is simply market movement. There are factors that impact our ability to handle investment risk. These are the concept of risk tolerance, and risk tolerance is worth focusing on because there's two components to risk tolerance. The first is financial. How much risk can you afford to take? If you were to lose this money that you're about to invest, would it materially change your life? And if it is, you have to be more conservative, and you have to recognize that this is a potential. So your ability to handle from a financial standpoint an investment risk is the first aspect. The second aspect is, how are you going to respond emotionally to this risk? And the way that investment professionals ask you to try to determine what your emotional risk tolerance is they'll ask you questions like, how would you feel if your investment account went down 10%. Well, that would be fine. I would do this. I wouldn't bother me, etc. What if it went down 20%? What if it went down 30%? And they try to tease out how anxious would you be? And the reason that they want to understand this emotional risk tolerance is that the worst thing they could do is to put you in an investment that doesn't match your ability to handle this, so that you're anxious all the time, that every time the market went down a little, you're up at night, you're pacing, you're checking your investments. That's not a good risk profile. Probably means that you're taking more risk than you're truly comfortable with, and you would need to be a more conservative investor. So financial ability to handle it and emotional ability to handle it are the two components of risk tolerance. The next super important term, or a super important factor rather, is your investment time horizon. I keep referring to Warren Buffett and his Berkshire Hathaway annual meeting. He talked about time horizons of 10, 20, and longer years. Now, obviously, when we are starting our careers and we're investing for retirement, we have very, very long time horizons. And that allows us to make very risky investments, to invest in growth stocks that may or may not work out, because we have time for our investment portfolio to recover and to compound and grow over time. If we don't have that luxury of time, if this is money that we'll need maybe in 10 years, we would not be quite as aggressive in how we invest. So your investment time horizon is very important. The thing I like to tell people is that you don't invest the rent money. If you need that money short term, in 6 months, in a year, even in 3 years, you're going to want to be very, very cautious about where you put it, because you don't want to take any market risk with it. You need it to spend, to pay for a particular bill or obligation. You have to know that it's in the account. The other component, the other factor impacting your ability to handle risk is your need for liquidity, meaning your need for cash. You never want to invest your last dollar. You need to have money sitting in savings allocated to cash for things that come up while you wait for your investments to work out. Strategies for reducing risk. Number one is asset allocation. Okay, and we're going to go into that in great detail over the next couple of slides. The other is diversification. Those are the two strategies we have for reducing risk in our investment portfolios so that we can sleep at night and so that we have a fairly good chance for our investments to work out. Asset allocation is very simply the division of an individual's assets among stocks, bonds, and cash. Fairly simple. It's an important decision. How are we going to divvy up the money that we have? So we've got sufficient cash, we've got some bonds, and we have some equities for the long term. And we make these decisions, how we do that divvying up, based on the individual's time horizon, their risk tolerance level, need for portfolio liquidity, and then tax sensitivity and unique circumstances. So obviously, with tax sensitivity, if you're in a very high tax bracket, there's certain investments you're going to want to hold inside a tax-deferred account so that you don't generate taxable interest or taxable capital gains and simply raise the check you need to write to Uncle Sam. Unique circumstances could include being responsible for the care and upkeep of a child or other dependent. Maybe you have to be concerned that this portfolio is there. You can't quite take quite as much investment risk because this money needs to be set aside for that person's care. One of the things that I like to talk to people about is the concept of an investment policy statement. Now, we've reviewed the risk tolerance and all the factors affecting your ability to handle and manage investment risk. One of the things that is in your best interest to do and in my best interest to do is to think about those concepts and to simply write them down. Create for yourself a little investment policy statement. When you go, for example, to Merrill Lynch or to other wealth management companies, and you are interviewed because you want to open up an investment account and have them manage your money, they're going to ask a lot of questions, as I indicated before, about your risk tolerance, your investment horizon, any unique circumstances, and they're going to play this back to you in a little formalized investment policy statement. It's going to identify what your return objective is. So for example, are you looking to grow your money for the long term? Are you looking to preserve your money? Maybe you need to live on income from that portfolio, so you're going to have a more conservative return objective. How much risk are you willing to take in pursuit of return? Do you have any constraints, including taking money out of this portfolio? Do you need some of the money within 5 years or less? How about taxes? Any other issues? The answers to those questions, those objectives and your constraints will determine the asset allocation of your portfolio. How much could be put into equity investments? How much risk the portfolio can therefore take? How much should be put in bonds, which should be more stable, generate more income, and how much should we keep in cash? Why is the asset allocation decision so important? Because different asset classes, stocks, bonds, cash, perform differently as business conditions change. It moves with the economic or business cycle, has a dramatic impact on investment returns. So let's take a quick look. This is a picture of the economic or business cycle. So you'll see, for example, the recovery phase after a recession. You'll have the Federal Reserve issuing stimulatory economic policies, lowering interest rates. Right now, they're trying to buy bonds and backstop credit issuers to encourage people to reopen businesses, keep their employees, and get back to work. The idea there is that if people feel more confident taking business risk, that confidence will improve, inflation will fall, and you'll start to see a pickup in the markets. If this is successful, and recall that we're coming off of out of a new recession, but after 2008, we had a very deep short recession and then almost 11 years of a bull market. So we had a long early upswing phase where people were feeling better and better about their prospects and their jobs. There's a lot of healthy economic growth, fairly low inflation, and bonds stable, stock market strong. We probably had our late upswing phase at the very end of the year into January. I think we had a market peak in February. Didn't see a lot of inflation other than in certain categories. And then we had this outside shock of the pandemic that caused a market crash. So we're in sort of this pandemic caused recession, and hopefully we'll come out of it within a reasonable amount of time. So as you look at these different periods in the market and business cycle, different companies have different abilities to make money depending on where we are. So let's look at some of these. Financial analysts divvy up the investing world, all of the types of companies that are available to invest in, into different sectors. It gives them the ability to look at these sectors and figure out how do they do as economic conditions change. So for example, looking at basic materials, these are companies that produce things like concrete, bricks, steel, screws, nails, things that are used to make other things. They do well when the economy is doing well. So right now, basic materials, their stocks are fairly low. Consumer cyclicals, they move with the market cycle, with the business cycle. So right now we're in a recession. So consumer cyclicals, things that people buy when they're feeling good. Think new cars, okay? Another example might be boats. When people are feeling good, when the economy is going well, people buy those types of things. When they're in a recession, not so much. Financial services can do well in either. So they move with the cycle. They tend to do better once they adjust when interest rates stabilize. Real estate moves with the cycle. Consumer defensive. These are things like consumer products, diapers, formula, and over-the-counter medicines. People buy this regardless of what the state of the economy is. So they tend to be defensive and to do okay most of the time. Healthcare. In a pandemic, that healthcare is an interesting investing category. Some of it is doing quite well. Others are not because there are no elective surgeries. That's only now beginning to reopen. Utilities, fairly stable. Energy, right now it's low because there isn't a lot of business activity. Industrial, same thing. Technology, that's going off the charts right now because everybody is relying on technology to work from home and to adapt to this, the shelter-in-place mandates. So these are the categories, and you can see how these different types of companies, based on what sector they're in, do differently with the business cycle. Asset allocation has the greatest impact on portfolio returns. So that first decision you make, how much will I put in stocks? How much will I put in bonds? And how much will I keep in cash? Is going to set your expectations for the returns that you can achieve. So on the left, we have our very simple stocks, bonds, cash image. But on the right, you'll see that you can get pretty granular, even in just the stock category. You see at the top, the light green segment, large cap growth. Cap refers to capitalization, and a company's cap size refers to the number of issued shares they have times the price of those shares gives you a sense of how big those companies are. So a large cap growth stock, a large cap company would be an enormous company. So think Amazon, Google, Facebook, IBM. These are large billions of dollars sized companies. A growth company is one that is expected to grow faster than its peers in a similar category. And the other option, if it's not a growth company, it's generally called a value company. So you'll see on the right a small cap value, that light blue pie slice. And a value company is one that is underpriced. It has a lower share value, stock share value, than peers, that if you looked at the business itself, it's got a lot of value, but for some reason that value is not reflected in its share price. Now, Warren Buffett, again, I keep talking to him like I'm a super fan, but he is one of the world's most successful value investors, and those are the types of companies he looks for, where he can make some small changes, whether to management or to marketing, invest in the company, raise the value of it, and make a lot of money. Okay. Your asset allocation corresponds to your investment objective. So remember that if you are a conservative investor, that if your objective is to preserve your money, you're going to have a conservative risk profile, and that's the type of mutual fund or portfolio that you're going to look to build. So if you look on the top right, a conservative portfolio in this illustration would have only 35% of US stock funds, 55% of bonds, and here 10% in international equity. If you are an aggressive investor, you have a long time, you're comfortable taking investment risk. It works with your time horizon, you're emotionally good with it, you're financially good with it, you're growing your asset, you would end up with a portfolio that is 65% domestic equity, 35% international equity. And this is an illustration that comes from Fidelity, their training center, to teach people how to invest. So asset allocation corresponds to investment objective. So the way you answer those questions about risk tolerance, time horizon, etc., will determine what type of portfolio you will be investing in. Now, your investment objective and your asset allocation will determine your investment returns. It's not realistic to expect a very conservative portfolio to beat the market. Okay, so you have to recognize that the trade-off is a conservative portfolio is not going to give you the type of returns that an aggressive growth portfolio will over time. There may be anomalous years where the conservative portfolio outperforms the aggressive growth because maybe we had a big market downturn and the bonds in the conservative portfolio outperformed. But over time, that's not what you should expect. The conservative portfolio, by virtue of being conservative, will underperform an aggressive growth portfolio. Now let's talk about this risk-reward trade-off. This is a fairly simple line graph illustration that gives you a sense of how does this risk and reward trade-off work? If you're very conservative and you allocate the majority of your money to a money market or government treasuries, you'll have a very low risk, but you'll also have very low returns. If that works in your financial plan, that's fine. But if you need to move out on the risk curve, and you'll see at the bottom, the risk percentage, the term used in investing is standard deviation, which is the percentage difference from the S&P, for example, from the market. So if you move out on the risk curve in hopes of getting a higher return on the left axis, the next stop would be an investment grade corporate bond. Yes, there's a little bit more risk in an investment grade corporate bond over a treasury bond, for example, as corporations sometimes are not well managed or fall into trouble. So there is a risk there that you would not get your money back, but you get a little bit more return for taking that risk. If you want more return and you're willing to take a little bit more risk, you could invest in what are called blue chip, which means large cap equities. Again, these largest companies here in the US in particular, a lot of them are not aggressively growing, so their share prices go up over time, but not as aggressively as they used to. So they're fairly stable. Their business plans fairly predictable. They can continue to grow, continue to release great new products, but it is unlikely that they're going to have an enormous out of the park type of success that will drive their stock shares, the values, up dramatically. If you're looking for that type of excitement, and again, if you're investing for the long term and you have the risk tolerance, some of those opportunities exist in what are called mid-cap companies. So these are companies that have been successful with a particular product or service. They're not yet fully built out. They are a service that is still building out, for example, new branches or new stores or investing in new markets. And once they get to an enormous cap size, you will find that they will become like other large cap equities back in the blue chip category. The super exciting stories that you hear investors talking about are small cap equities. So these are brand new companies, and they come out with some brand new service or product that people all of a sudden have to get. This is where most companies start, and then they do well and eventually become more predictable and eventually become blue chips. So this is the risk and reward trade-off. Now you could have these small caps when they work out are tremendously valuable and you get a great return. But remember that not everything works out and that sometimes these small companies come out and they fail or they simply get gobbled up by bigger companies. There's a lot of that happens now. So it's a pretty dynamic market. So let's turn next, now that we've talked about asset allocation, let's review diversification, which is the other important strategy for reducing risk in your portfolio. This is the age-old adage, don't put all of your eggs in one basket. What this means, essentially, is that you never invest in one stock. Because what if there is a unique risk in that particular company affecting that particular stock? People, for example, who worked for Enron, and most of us on this call, I think, are old enough to remember that story. Enron was this accounting and consulting firm, came on the scene, was phenomenally successful, grew by acquisition. You just couldn't escape them. They had this crazy growth stock experience, and it turned out that what was driving that, underlying it, was a lot of accounting gimmicks and fraud, and it collapsed spectacularly, and people who had invested in this stock, and unfortunately a lot of the employees had it both in their 401k plan and in their stock purchase plan, all of them got hurt. So you never have just one stock. It also protects you against the risk of overconcentration in any industry, sector, or asset class. I often have the conversation with clients. I see this frequently with people in the technology field or in the medical field. These are the things they know and what they want to invest in. So if I work with a programmer and, yes, it seems great. There are a lot of well-performing investments in the technology sector, but there are other sectors and you need to diversify in case there's a big downdraft and all of those stocks that you hold get repriced. Same thing in pharmaceuticals and investing in hospitals. You need broader diversification than just one sector. So how do we achieve diversification? Well, you can invest in stocks that differ according to company size. We talked about capitalization, that's share price times the number of shares outstanding. And we have large, we have medium, we have small cap, all with different risk profiles, as we described. You can invest in stocks that differ by style, whether you're buying a value stock, a growth stock, and I'm using stock, but you could say fund or ETF, or you could have a blend of both value and growth in a particular mutual fund or portfolio. Then you can diversify based on location, whether you're interested in investing in domestic US companies only, or you'd like exposure to some of the great international companies. That's a great way to diversify your money. So for example, if things are looking brighter first in Western Europe as they clear the pandemic and get back to work, might make sense to look at some of their companies while we're still a few months or weeks behind getting back to work. The other way to diversify is to look at cyclical companies that move with the business cycle, sensitive companies, and sensitive refers specifically to how sensitive is that company's business prospects to interest rates. So an example of a sensitive industry is insurance companies. They are very sensitive to where interest rates are. Banks can be sensitive as well. Defensive, meaning they don't really have a difference in their business whether we're in a recession or whether the economy is going great. So these are all the ways that we can diversify our portfolio. Where do you look for diversified investments? One of the great inventions for individual investors are mutual funds. They, by virtue of what they're charged to do, offer diversified holdings. And you can buy very broadly diversified funds, or you can get more concentrated funds. So if you wanted a sector fund, that would be more concentrated. But they offer diversification, owning many individual shares, individual companies. They have professional portfolio management, a team that is compensated to do right by its investors, make sure that they're optimizing and delivering on the investment objective. It's important that they have a defined investment objective. So if you buy a growth investment mutual fund, you should have investments that are all in growth companies. The other benefit of mutual funds is that they have standardized investment return reporting, which is important. You want to know, how did my growth fund do to the others that are out there? Because there are hundreds, if not thousands, of funds in every type of objective category. So you want to buy a good, well-performing growth fund, and you can check the investment return report to see how it's doing against its peers. Mutual funds are very easy to buy and sell. If you are buying them in a brokerage account or buying them directly, when you make your purchase, you can call up anytime during the day, but your actual purchase will happen at 4 o'clock at the end of the trading day, because what they do is they tally up the number of shares times the value of all the assets in the portfolio to figure out the share price, and then they can do the transaction and process your purchase. Same thing when you sell. You can place the trade early in the day, but it will be executed at the close of the market at 4 o'clock. They do automatic rebalancing. So again, if you're in a growth fund, it will stay a growth fund if they have bonds in it for any reason. They will never get out of whack if it's supposed to be 80% stocks and 20% bonds. If the market goes down and they then have 30% bonds, they will automatically rebalance to keep that static. So you don't have to worry about it, which is nice. Mutual funds also, as I mentioned earlier, give you the choice. You can have an actively managed fund where you've got this portfolio manager pursuing growth stocks, usually with a team of researchers, or you can adopt the passive strategy and invest in an index that will match either the S&P or the total market or the Dow Jones or a number of other available indexes. So I mentioned passive versus active index funds. You can have growth or value-oriented funds. They differ by style. You can have growth or income funds. They differ by investment objective. You can have straight international funds, emerging market funds, and emerging markets are countries where there's an emerging middle class. Because when you have an emerging middle class, people suddenly have enough money to buy things, expensive consumer goods, washing machines, refrigerators, cars. And when you have that consumer demand, those markets tend to grow rather well. So these can be good places to invest. Now that said, in economic development, things happen. Things like the pandemic. The emerging market sector right now is under a lot of stress because some of these emerging markets are really struggling to overcome the effects of the pandemic. And so that has been a bit of a struggle for them, and it's not clear when some of these countries will prevail and get back to business and begin to resume their growth. You can invest in alternative investment funds, and you can invest in sector funds. So for example, if you did want to invest in technology or healthcare or biopharmaceuticals, these are all very familiar sectors, and there are a lot of sectors that you can invest in specifically. Important mutual fund investment criteria. One of the things you're going to want to look at is how much do they charge? You're going to want to look at low management expenses because management expenses are reduce your return. So it's important to make sure that you're not overpaying to have your portfolio in your mutual fund managed. You want to compare and evaluate mutual funds based on longer-term investment performance. What it did last year might have just been luck. If you want to check if you've got a good, skillful team managing that money, look how they did over 3 years, 5 years, 10 years, and since inception. Skillful portfolio managers tend to do best long-term. The stability of a portfolio management team is often an indication of how easy it is to meet the objective of that particular fund. If there's a lot of turnover in the portfolio manager, it's probably because it's an impossible job and they leave to pursue other opportunities. A team that works well together tends to do well together. And so that stability can be very, very helpful for the investors in that fund. Low portfolio turnover. Every time the portfolio managers buy and sell positions, there are costs, transaction costs for changing out those particular investments, and that you pay that cost. So if you have a portfolio and you look in the prospectus, which is the document you get detailing everything about the fund, it's usually mailed to you after you buy the fund. And if you look in there and you see that it has an average annual turnover of 90%, you're going to be paying a lot of money just in transaction fees. And that is not necessarily in your best interest. It also suggests that there's a lot of effort to try to beat the market rather than wait to see if some of these investments will perform well over time. Good investment performance relative to peer funds and the benchmark. So you always check your growth fund, for example, against other similar growth funds. So it's apples to apples to make sure that you're in a good one. Exchange traded funds. I mentioned that I would explain a little bit more about what these are. These came about when institutional investors, people running pension funds, college endowments, big institutional money like that, wanted to spend less on transaction costs. And so what they developed was an alternative to a mutual fund portfolio. They created indexes with the idea that rather than sell out positions, they would simply exchange them with other people invested in the same thing. So they have very, very low transaction costs. What this now allows retail investors like you and me to do is to buy a simple basket. And in that basket, say you have 10 financial stocks. You've got 10 big banks and insurance companies. This basket of 10 financial stocks never changes. Those 10 stay the same. Because it always stays the same, it actually has its own ticker or trading symbol. And I can buy or sell this basket of stocks anytime during the trading day. So if I want to buy it at 9:30 when the market opens and sell it at 2 in the afternoon because these went up, I can do that. I have that kind of control. So you've got the ability to buy it and sell it like an individual stock or bond anytime during the trading day. But because what's in it is static, it's much more like an index or passive fund than active management. The composition doesn't change. It stays the same, those same 10 financial stocks. If you look at ETFs, this is where all the growth in the investing industry is happening. They are creating ETFs out of all kinds of stuff. It started with baskets of sector stocks, as I mentioned, financials, there's technology ETFs, pharmaceutical, healthcare, and on and on and on. Then they went into creating indexes of indexes, which is really, to me, kind of mind-boggling. There's now an effort afoot to get an ETF created out of Bitcoin and other similar types of virtual currency. So there's a lot of creativity going into this. What it does do for you is give you tax control, Again, because you make the decision when to buy or sell your holding, your particular ETF shares. And it has lower cost structures, again, because it's static and there are no transaction or very, very tiny transaction fees inside. So they can be a good thing to own in your portfolio. One of the downsides of mutual funds, if you own it in a taxable account and you have, for example, an active fund, so you've got a portfolio manager trying his best to grow, pick good growth stocks, and at the end of the year, he sells it all to realize the gains and look like a hero. If you hold that in a taxable account, you're going to get a 1099 for all of those capital gain distributions. And even though you didn't take that money out to spend it yourself, you will have to pay taxes on it. That is one of the things you do avoid by owning an ETF, is you don't have those unanticipated capital gain distributions. All right, now we're going to talk, as we wrap up here, about historical stock market returns, just so you have a sense of what these are, what you can expect. Remember that long-term stock markets, we're talking about 10 plus years typically, range or average 7 to 10% annually. So you often see on literature from Vanguard, from Fidelity, from Schwab, illustrations that use either 7 or 8% as an average annual return for, say, a growth fund. This is why your investment time horizon is so important, because if you're going to expect to get that 8% a year annually, you need to be in it for 10 years, at least. So what has the stock market done over time? This is an illustration of the S&P 500 index returns. So it's the ending value for each trading day, each year since 1950 to June 2017. And it shows that over time, this has gone up dramatically. So that if you had invested, for example, when you joined the workforce in the 80s, you started putting money into a 401k plan, you had a typical career, you worked, you contributed, you saved, and you retired, hopefully, either before or after the financial collapse. You saw the value of your portfolio go up dramatically over time. If you waited out that dip in 2008, the value of the account came back. Okay, and you can see that it went up to 2437, June 2017. And of course, in the 2 years since, it has gone up even more dramatically. It was at 29,000 at the peak, and now it's about 28 and change. What are the things that happened? And you'll see in this slide, you see these dark bands, vertical bands. Those represent recessions. So you see in response to almost every recession, a market decline. But once the recession is over, it almost seems like the market gets supercharged and begins going up. What happened to prompt those recessions? Well, if we overlay the little explanations, it's fairly interesting to look at. Looking at the 80s and 90s, you'll see the international banking crisis, which sent the market down. Black Monday, which happened in 1987. That's actually when I first worked in the investing business. That was an interesting time to start. You saw in the early 90s the economic crisis in Japan. Then we had this long period of phenomenal growth, the 2000s. It seemed terrific, right? Then we had the Asian tiger currency crisis, which sent things into a brief tailspin. Then we had in 2001 the new economy and the collapsing of the dot-com bubble in April 2001. What happened also in 2001 was 9/11. That sent us into a pretty steep but short recession. And then we had 2008, which was the United States housing bubble. So it's interesting to watch what precipitated each of these. When this gets updated in a year or two, we'll see the impact of the pandemic and the 34% market crash that happened immediately after that. This is another way to present fairly the same information, but it tells you something a little bit different. Presenting the year-end returns, bracketed, so you'll see that the red represents years where the market went down, and you see, for example, there were 12 years where the market went down 0 to 10%, 6 years in this illustration where it went down 10 to 20%, 3 years when it went down 20 to 30, 2 years when it went down 30 to 40, and 1 year, 1931, when it went down between 40 and 50%. On the other side, these are all the years when you had positive returns. And you'll see the same distribution of percentage returns. There were actually 3 years when the market went up 50 to 60%. So 1933, 1935, 1954. Point out a couple of things. Yes, 2/3 of the time here, the market returns were positive. So on average, this is why, particularly as you invest over time in a 401k plan, you can count, if you do that consistently over the years you're working, to do better, because the majority of the time you'll have a positive return. You will have some years when you will have negative returns. It's the way it works. It's not a perfect bell-shaped curve. There is a measure of central tendency. You'll see that the 13 and 18 years where you had between 0 and 20%, those are the majority of returns. So more than average, more than likely, you'll be somewhere in there each year, which is why when you look decade after decade, the average long-term rate of return is 8%. And it's because most of the data points will come in that particular category. But you do have these outside events, these black swans as they've been described, that out of nowhere comes this global pandemic. Obviously, we're not, done with the year to know what the final return in the market is, but we have to be aware that that can happen, that each of the crises on the previous slide, those came about, those had a market impact. But over the long term, if you stay consistent, if you stay invested, you should have a positive return. Briefly, before we wrap up, I promised to explain how different types of advisors in the investment world work. They all have different standards of customer care. And I'll explain what that means. Many people work with investment representatives. If you had a traditional Merrill Lynch broker, he was somebody or she was somebody who could buy and sell investments for you, usually for a commission. That's the very traditional model. They are required to consider the suitability of a specific investment or fund recommendation given your situation and your investment objectives. And they are regulated by FINRA. That's the organization that makes sure that people are operating appropriately when they're buying and selling investments. If you worked with an investment advisor, and there are investment advisors who work now for Bank of America Merrill Lynch, JP Morgan Chase, Citigold, and other investment companies, they can buy and sell investments for you. Generally, they're organized to do this for a fee based on the size of your assets, the assets they have under management. They are required as investment advisors to serve as a fiduciary and to consider your best interests in recommending a specific investment or fund. It's got to be absolutely appropriate and in your best interest. Investment advisors are regulated by the SEC, Securities and Exchange Commission, or the New York State Attorney General. There are hybrids. There are many people now who are called financial advisors. That's their title. Sometimes they're called wealth advisors on their business card. And they are often a hybrid of those first two categories. So they can be regulated as an investment representative when they're selling products under the suitability standard, but they can also serve as a fiduciary operating under the best interest standards when managing assets, say in a managed portfolio program. So it is a little bit confusing, but you have to know that a hybrid financial advisor or wealth manager can switch hats and go from one standard of customer care to the other. Either he's looking at something that's suitable or he is upholding the best interest standard. Certified financial planners, they always have to be fiduciaries. To call yourself a CFP, you have to be a fiduciary at all times, but their business models can vary. Many of them work under registered investment advisors to offer investment advice. Some are fee only, and some charge by the hour. Okay. They too can do investment advice, and it depends on their model, whether they take assets under management and charge a fee, or whether they charge a project fee or by the hour. So I'll leave that up so you can look at it. Actually, now I guess I'll check and see if we have any questions before we wrap up.
We do have a question. I think the second one.
Sure. Can you comment on the current stock market environment we are in, and what is your opinion of whether we are at the bottom and when might the market begin to go up again? This is a fairly complicated question, and I'm going to give it my best shot. I believe that since the market crash on March 23rd, when the stock market went down 34%, that we have been in a bit of a bear market rally. And a bear market rally is when you see the stock market begin to go up a little, and we think, phew, we're out of it. But we're not. It goes up, it goes down. There's a lot of volatility, which we have seen since certainly April. We had days when we saw the market go up 400 points and the next day go down 600. Responding aggressively to either good news or bad news that came out of the pandemic updates or the economic updates. There's been a lot of positive response every time the Fed made a move or the Congress approved the stimulus plan. That would send the markets up. Then there would be some bad news about the prospects for a particular treatment or the vaccine, and the market would go down. So I think we are in a bit of a bear market rally. I think that getting out of this is going to require seeing some real business success when we go back to work, when we see states open up, that they're actually doing real business, that customers are showing up, that sales are being made, that people are starting to feel confident, people are going back to work, getting rehired, coming off furlough. Once we see that, we will see, I think, fairly steady progress up. And I'm hoping that this current position where we are right now doesn't last for a long time. It's, impossible to say, because there is the concern that we could have further outbreaks. We could, see more people, unfortunately, go into the hospital and die, and that will cause people a lot of anxiety, which will be reflected in the market. I hope that answered your question. Are my slides available? Yes, I always send them to Shana. Are these posted, or do you just send them out?
Whoever wants it, I can send it to, but I don't have the second one.
Okay, I can send this to you.
The one last week, yeah.
Yep. Would this be a good time to invest since the stock prices are lower? My answer there, if you have a long time horizon, meaning that you are able to sit back and wait for this to come back and the economy to recover, you've got 7 to 10 years, this is a good time to look. And the way I would do this would be to look at an S&P 500 index or a total market index and put in a little bit at a time. So doing that is similar to investing in your 401k plan, where it comes out of your paycheck every pay period, and every quarter you see it go into your 401k. That's called dollar cost averaging, where you invest the same amount of money at different time intervals. And what you get is, when the market's down, same amount of money buys more shares. If it goes up, you buy fewer. But over time, you get the geometric average of those prices, and that will help you improve your potential for a greater return. So rather than jump in with all your money at once, I would do a dollar cost averaging approach. And whether you do it once a week or once a month, we may be in an uncertain period for quite a few months. Some people are predicting well into the third quarter, so September, maybe through the end of the year. So if you did this every month for the rest of the year, you could set yourself up for when we hope we have a good recovery in 2021 or 2022. Okay, I'll move down. I think I got another one. Nope, that's it.
I know Diana raised her hand, but I'm not sure if she wanted to say something. If you do, you're still on mute, you can just go ahead and say something. But other than that, if anybody else, okay, if anybody else have an additional question, you can go ahead because we have a few minutes.
Okay.
Right, but if not, yes, the last slide, the last PowerPoint, please can you send it to me because I have some people ask me for it. And
absolutely,
if you want it, you can just email me and just let me know that you guys want it, and I can email it to whoever wants it.
perfect.
Okay.
So next week is our final session in the series, and that is putting it all together to create a retirement income plan. So that's where we touch briefly on the subjects we've covered so far, but we talk about the different strategies of putting together an income plan for when you decide to stop working.
Okay, sounds interesting.
Okay.
Thank you again, Anthea, and I'll talk to you next week.
Great.
Have a great afternoon and the rest of the week too.
Thank you. You as well.
Bye-bye.
Bye-bye.